All right, guys. Good morning. Is it Thursday? It is Thursday. Give me a thumbs up or put a message in the chat if you guys can hear me, or just give me a thumbs up. Troy, you can hear me? Okay, good. Well, I'm happy that we are jumping on this call. I was sharing with my team, I feel like we are in the middle of winter, not by the temperature outside, but from a harvest standpoint of we have to learn how to harvest even during the winter season. And so, how do you go about doing that? Well, a lot of the ways that you can go about doing that is by working with a lending partner that can show your clients numbers and really the cost of waiting or a rent versus own type numbers so that they can physically see with their own two eyes why now it still makes sense to buy. You can't just tell people that. In 2023, people's BS thermometer is through the roof. They don't want you to just show up and throw up and tell them why. We're incented to tell them to buy now. That's how we get paid. They want to see the math. They want to see the numbers. So what I wanted to do with you guys today is just spend 20 to 25 minutes, and then I'd open it up to any Q&A if you guys have anything. But what I want to do is show you what we're doing within the Nerd Group right up front with every client that we speak with to, one, instill education in the rate market, education in the numbers that we're showing them, because I firmly believe that with education, they have the confidence and they feel empowered to make the decisions. Otherwise, people get paralyzed in indecision, right? So we're educating them first and foremost. And then second is we're showing them these numbers and what's going on with the market so that they have the confidence to pull the trigger now, because I'm going to show you why now it's a lot better for people to buy than wait. But by seeing behind the curtain of what we do with every client, I hope that it gives you the confidence and at least the knowledge behind what the nerds do up front, so that when you send a client to us, we don't actually show you all the stuff that we do behind the scenes. So some of you guys might not even know that we're showing them a rent versus own or an FHA versus conventional, and how sellers don't really love FHA loans right now. So if we did go conventional, this is what it's going to cost you to make that decision. But if your dreams home is worth it, then it might make sense, So I wanted this call to show you guys more behind the curtain and the numbers that we're showing clients, so that you know that we're equipping them with the right amount of tools, knowledge, and education to feel confident about either buying or selling in today's market. So I did set this up as a meeting format. I'm also recording it. So if you've got other real estate agents in your firm that couldn't attend, don't worry, we can send it out to them afterwards. But type notes in the chat if you've got questions. If you want me to slow down, let me know, because this is truly meant for you guys to just know more upfront about what we're doing to show your clients. So I'm not here to just talk at you guys. I want you guys to be able to, know the numbers yourself. So let me pull up my screen. Let's do this one. All right. Can you guys see on your screen a bunch of red and green? Okay. So the first thing I want to show you guys is when we're having an initial conversation with clients, one of the first things that we show them when they get pre-qualified or pre-approved is this here. And what this is technically the price of mortgage bonds and how they're fluctuating every day. I don't get into the nitty gritty about why and all that stuff in the initial meeting, because they don't really care. It just makes their head spin and make them shut down. But what I do tell them when we issue the pre-qualification or pre-approval is my primary role on the team is to make sure that you not only get the lowest interest rate, but the smartest strategy right now. And there's a big difference. If you're not working with a lender that's a certified mortgage planner, they likely have no idea how interest rates work, let alone that they change every single day. So here's an example. I pulled this up on the screen with them. Here's where we are today. This is August 17th. Here's a look back 3 months ago. And what I stress to every single client is what this tells you is that every single day, interest rates change. Not only do rates change every day, but they change multiple times throughout the day. So if I come here at this really big green candlestick is what it's called, you'll see that it's this little black box pops up and it tells you on July 12th, we had a really big long candlestick versus like here, which is July 3rd, we had a short red one. all that tells us is that on July 12th, the interest rates changed a lot on that day. We'd have to look back and figure out why. There's so much stuff that's going on with the economic news that there's a million reasons why I could tell you why it happens. But when a lender is issuing a pre-qualification or a pre-approval, we have to use an interest rate to generate a payment. And I asked the client on the phone, knowing that interest rates are changing this often, would you rather me use a best case scenario rate or a worst case scenario rate as you go out and start shopping for homes? What do you think they say? Give me it in the chat. What would you want your clients? You want them out shopping with the lowest monthly payment? Or if they wake up today and rates go up and now they're like, oh, I don't want to go shopping for homes anymore. My payment went up $50. Worst case, worst case, worst case, right? Everybody says worst case, except for most lenders. What do you think they do? They use best case, because the only knowledge that lenders have or that consumers have to shop loan officers is based off of interest rate. And they think that the interest rate is a quote during that pre-qual or pre-approval phase. And it's not. It's not. We can't lock a rate in until an offer gets accepted, we have a property address, and we have a close date. That's when a lender can lock in an interest rate. So if I send out a pre-qual letter and it has this rate on it, we tell the client, we're only using an overestimated rate because this is literally what's been going on. And if I expand this out over a 2-year time period, now take a look at this. In fact, sometimes if I get really detailed finance-driven type people, I'll go out 3 years. So you see how this line is really high in the 2021? When the price of mortgage bonds are high, the interest rates on mortgages themselves are low. It's an inverse relationship. So here we had really low rates. Here's all of 2022, took a nosedive. That's when we heard rates going up. And here's where we are today. But the good news is that October of last year is actually when they were in the worst position ever. So I'm sharing this with you guys because this is showing clients behind the curtain that, number one, interest rates move every day. Number two, a pre-qual or a pre-approval quote that you may have got from Chase Bank 3 months ago is not a rate quote. And it's equipping them with this knowledge. And then I share with them, if you go to my Instagram page, I have this little rate update icon. So you guys are more than welcome to look at this yourself, share this with clients. But I update this rate update highlight every single week. So if you miss my story about what's going on with rates that week, all you have to do is click on this rate update and it'll tell you what's going on with interest rates. So I give them a little bit of facts and it's always the most current. So this is my most current one from last week. I will remove this and replace it with this week's. And that's something that I encourage my clients to follow. Like, here's the bond market down here. Again, not that they really know how any of this works, and not really that you guys need to know that any of it works, but it is helpful for them to know that you're going to hear on the headlines like interest rates went up, interest rates went down, interest rates went up. But you have to ask yourself, compared to when? Like yesterday or last week or 3 months ago? Because this is the roller coaster we've been on. So I wanted you guys to know that, have that knowledge yourself, that this is what's going on. We are expecting interest rates to start coming down. I know we said that back in May, and then we had a lot of stuff, a lot of economic events that happened in May. If you didn't get my invite for Tuesday here in Plano, the owner of Keeping Current Matters, who runs all those statistics about what inventory is doing, sales prices, mortgage rates, he's doing a private mastermind with all of our realtors here in Plano at the hotel behind our office. You guys are all more than welcome to come, bring a buddy. But he's going to equip you with knowledge and then like tangible things that you can show clients so that they don't have to take your word for it either. So that's that. I wanted you guys to know that. Now I want to get into some nitty gritty math and strategy. And I felt like the easiest way to do this was to show you real live examples. So I'm not sharing anything about clients' personal information. You might only see their first name. If you're on this call and it's one of your clients, don't worry, another agent can't snipe it or anything, but I want you to see what I'm showing your clients up front. So the first one we're going to look at is we had a client come in and they're making the decision to buy a home. I know this is so tough to see probably on your screen. I can't make it any bigger, I don't think. I don't want to try and screw this up. But they came to us, they said, hey, we're looking to buy our first home. That was it. They didn't ask me to run what we call a rent versus own. But if my job as your partner is to equip them with the most amount of knowledge possible that this is a good decision to do, I should not only issue them a pre-qualification, but I should also run the numbers for them, right? Like that's like bare minimum if you're a true advisor. So in this particular example, they were paying $1,500 a month in rent. They did have a roommate, that's why it's cheaper. So here's their $1,500 a month in rent. They were looking for a $400,000 purchase price. In this example, they had 10% to put down. So we showed them the $400,000 purchase price, told them earlier about the interest rates, but we're going to use a 6.875 for now. It's going to give you a monthly payment around $3,352. They actually qualified for up to $500,000. So we will always inform the client of what the max the lender will approve them for. Why? Because if it's Saturday and they fall in love with the house at 400,000 or 410, and you're like, Denise, we're going to have to offer 420. You don't want to do the back and forth with me and the team if they qualify for 420. You want to know that they do and that they've seen the numbers for it and that they can pull the trigger right then and there. So we show them this 400,000, and then on every client right now, we're explaining to them that we are predicting interest rates to come down in the next 12 to 24 months. And if and when they do, we have a post-closing customer service team in-house because we care about our clients and their finances. Our services do not stop when you close the loan. Every month, we will analyze your equity and your interest rate. And when rates hit rock bottom, we will reach out to you with our rate redo loan program. It's zero out of pocket for you. We drop the rate, we drop the payment. So if rates go back to that 4.875, Mr. Customer, that $400,000 home that you bought with a payment of $3,352 goes down to $2,892. Why do you think it's important that they know that that $400,000 home, as long as they can afford it for a few years at $3,300, that it could go down to this $2,900 mark? Do you think that that's important for them to know up front? If they fell in love with that $415,000 home and they can make it work for a couple of years. Now, sometimes some real estate agents, it makes them nervous. They're like, but how can you guarantee that rates are going to come down by then? Well, I can't, but I do study the market. I got into this business before the housing crash. We know trends. Thankfully, this isn't the first time we've been in a market like this. Rates come down when inflation comes down. Now, the feds have been manipulating inflation with the federal funds rate and the purchasing of mortgage-backed securities, but they can't do that forever. And so as we start to see healthy inflation come down, that's when we'll see mortgage rates come down. And guess what? Your client will be bombarded by other lenders as the rates are on the way down, which is horrible because if they get that one person on the phone or that one mailer, they pay an arm and a leg in costs and they pulled the trigger too soon because rates didn't hit rock bottom. If your lender partner has a customer service program after closing, your client feels like you and I have a vested interest in them even after we got paid. So what do you think the likelihood of getting more referrals from that client would be? So many times real estate agents get frustrated because they're like, man, I give leads out to everybody. You know, you guys are the fishermen. You have to catch all the fish. You give it to title, you give it to the lender. Like, what does the lender do for me? When does the lender ever give me a deal? Well, the truth is that if you're a mortgage banker like me, where you don't work at a big retail bank, most of your clients come from real estate agents. And if you have any amount of integrity, then if I got this real estate agent from Sarah or this client from Sarah, and 2 years pass by and that client sends me their friend and says, hey, you got to call the nerds. They might not remember Sarah, but we have it coded in our system. And so when they get pre-approved, we're going to say, oh, you've got to work with Sarah. She's great. She knows the area, because that's the integrity of our system. And when you have a really good follow-up program and you have customer service even after closing, it should generate more referrals back to you. Now, if you work at Chase Bank, you have clients that just walk into the bank, maybe for a checking account, and they make their way over to the loan officer. And so they might have more options. I'm just being honest. They might have the ability to give you clients, we call them agentless clients, more than like a traditional banker like me. It's just then you got to close the loan with them. And I can't knock them because that's where I started. But that's why, is because we have a system coded for every agent. And we have some agents that we don't work with anymore, but even when they come back to us, we send them back to that agent because it's all about integrity in the business. But we all know that the fortune's in the follow-up. So if you're providing knowledge like this up front, and then your lending team has a service program even afterwards, you will get more business just purely because people know that you care about them, right? So here's the other thing I want to show you is, okay, we're showing them the potential of this, but here's where we hit them with the pain. Mr. Customer, in your first 60 months, I wanted to show you that you would have paid $95,000 in just rent. Does that make anybody else want to vomit? Like $95,000, what would you do with $95,000? If you purchase a home today, you would put $21,000 back in your pocket from just the principal portion that you get to keep by being a homeowner. And in 15 years, based on a modest appreciation rate, modest, which is 4%, your net worth as a renter is zero because you're not getting anything out of the rent. But as a homeowner, it's almost $500,000. And guess what? That's at an interest rate of 6.875. When we hit them up front with this number, now they didn't ask for it, but when they see $95,000, do you think that they're more motivated to buy? When we're talking to them during the pre-qual and we ask them what their financial goals are and they just want to retire sooner, or they want to be able to travel the world and not be, stuck to their job. Do you think home ownership of gaining $500,000 is going to help you to retire sooner and travel the world? Yeah. You think any other loan officer in America shows this kind of stuff to your clients? Probably not, because they're just a loan officer and they're not a mortgage advisor. So that's one example. Let me show you another example. By the way, if you've got questions, I see 2 chats. Let me see. Highest payment, worst case. All right, let me show you Gonzalez. All right. This was one that we did where they qualified for both FHA and conventional. And so let me switch the view. Okay. So we were showing them now FHA loans. It's tough because if you have a FICO score under a 700, in fact, let me just show you guys this. This is really nerdy. But if you go to Google, this is all public info. I tell all my clients this. Literally pull up Google. You type in LLPA Fannie Mae. That is loan level pricing adjustments. You click on it. It's going to pull up this first page. You can skip it. Just go to the second page. This second page shows you what the rate adjustment is based on just 2 factors. There's way more to rates than just 2 factors, but your FICO score and your down payment. Here's the FICO score categories for conventional loans. If you have a 780 or above, you're going to be in the top tier. 760 to 779, you're in the second tier. 740 to 759, third tier. This was just added this year. It used to be if you had a 740 or above, you were in the top tier for interest rates. Now you're in the third. If you come over here and you say you're putting 5% down, that means you're financing 95%. Here are the rate adjustments to the rate. If you're in the top tier, you get a 0.25 rate adjustment. If you have a 700 FICO score, y'all, that's a good FICO score. There's a 1.125 rate adjustment right off the bat, what Fannie gives to all the banks. So FICO score matters tremendously when it comes to conventional mortgages only, not FHA. Then you come down here and there's investment property adjustment, second homes, if they do a first and a second, all kinds of stuff. But my point is that a lot of times people think that FHA loans just means you have really crappy credit or you have a really small down payment. But you have to rewrite your brain. And if you're representing a seller, you definitely need to. Now, if you have a 700 FICO score, you could get not only a better interest rate, but a better monthly mortgage insurance rate. Doesn't mean that you have crappy credit. And the double whammy is FHA allows you to have a higher debt to income ratio. So when we're in an affordability problem type market, a client with a conventional loan, just as an example, might only be able to afford a $400,000 home, but if they go FHA, they could get approved for a 480. There's a huge purchasing power difference just because of the debt to income ratio tolerance. So don't just assume that they're going FHA because they have crappy credit or a low down payment. It might just be because they want to borrow more home, and right now rates and home prices are high. But in this example, this client, just as an example, qualified for both, and she was right at, I think, a 710 FICO score. So I'm showing her, she didn't ask, but this one is a first-time home buyer, and the notes were like, she's one of those people that WebMDs everything. So, or Googles everything. So young generation thinks they know more than the professional, probably. I'm showing them, here's an FHA, here's a conventional. FHA might be a 240 purchase price. You might get a 6.875. Your monthly payment would be 2,187. Your total funds before an earnest money deposit and all that would be just under 12.5. That same home conventional, they've got a rate of 7.375. That sounds way worse than a 6.875. Makes your payment 2,227. It's $40 difference. And your funds to close, because they have 5% down, so we kept it at 5, would be a little bit more funds to closing. And then, like I said, we always show the rate redo just so they can see what that monthly payment will be. But what's important is this chart here, because the real estate agent said, if at all possible, we need to go conventional because they're looking at properties like condos and stuff that might not be eligible FHA. So here I have a first-time home buyer who Googles everything, who wants the lowest rate possible, because what they said is, I want the lowest interest rate. Well, what good is the lowest interest rate if you can't get an offer accepted? FHA is technically the lowest rate program. So I said, I want to show you both. And what this chart tells us is comparing FHA versus conventional over the next 24 months. I fast forwarded you in each one of those loan programs, assuming you were in both of them. In 24 months, where would you be financially? Well, the conventional loan would end up costing you $1,485 more by going conventional than FHA because of that higher interest rate. So FHA would make more sense because you'd save money. But here's the thing, Mr. Customer. This market is really tough for FHA buyers. So I wanted you to have this information because I know you said to me that it was important that you had the lowest rate possible. But I have found sometimes that having the lowest interest rate in the wrong loan program could prevent you from getting an offer accepted. So I wanted to show you this conventional option, even though it has a higher rate and even though it would cost you close to $1,500, because if you and Troy went out and found the dream home, and the only way that offer was going to get accepted is conventional, I want you to know that what you're giving up is about $1,500. And if it's worth it to you, then sign that contract and make the offer. Give me some reactions. What do you think about that? Do you think that would help educate your clients? Do you think that when you're out in the market and you have to go, like, give me some feedback of what you guys are thinking. Ronnie, my interest rate page gets updated once a week, usually every Thursday or Friday. Y'all aren't going to give me any feedback? Do I have to call on somebody? Let's see. Who am I going to? Oh, the Fannie Mae page. It gets updated anytime there is a change from Fannie Mae. Trey says, I think that was awesome. Everybody else is being shy. This is great info. Thanks, Lane. All right. So sometimes it just takes showing people the numbers. And this is why I initiated this Zoom call is if your lending partner is not a mortgage advisor and they're just saying you're pre-qualified, go out and find a home, then your clients can't quantify the decision that they have to make. And when you're buying one of the most largest purchases that you've ever made in your life, you can get paralyzed with indecision and all the crap we see on Google and social media. This is another strategy that we do to show clients, hey, I will write an FHA or a conventional loan. I'm good with it. But my job as your mortgage advisor is to show you all of your options so you can make the most informed decision for you and your family. Now, even though we haven't closed on a loan just yet, if you're the real estate agent that told this client to call the nerd group, do you think that this makes you look good? Like, we're an extension of your brand. So the fact that we're delivering on things that they didn't even ask for, it was unexpected, it's a representation of your brand. They're gonna potentially tell people about you even at this stage before you've even helped them close a deal. So I just want you to think about that in the 2023 market, when everybody is really starving for business, who are you giving the business to? And are they making you look better or worse in an effort to get more business? Let me see if I have another rent versus own. We do this all the time with like down payment assistance or not, or I have a cost of waiting. So let me just show you. Let me come back here. So one of the things, I'll just do it within this one. So I will tell clients, okay, let me add. This is truly behind the scenes. If anybody's driving, so I'm going to call this wait 1 year. And I'm going to copy the conventional. If someone waits 1 year, by the way, I almost always will pull up this real estate report card. I can pull it up no matter what county it is all throughout the US. We are licensed in several states outside of Texas, if you didn't know. Florida, Colorado, California, Oklahoma, Colorado, Montana. So I can pull up any county and it'll tell me the median home price. And it will also tell me what the average appreciation forecast is going to be. So what this tells me is that in Denton County, over the next 12 months, what's forecasted, unless rates come down and buyers flood the market, we're about at a 1.9 appreciation rate, which isn't fantastic. You know, normally the average is 3%. But over the next 5 years, we're expected to be back to the 10.13%, and that's keeping all variables held the same for today. So when I use a modest appreciation rate of 4%, I feel like that's modest. But when we talk about the cost of waiting, because sometimes when I show clients, well, interest rates are going to come down, you know, in 12 to 24 months, I'll say to them, naturally, the next question is, well, should I just wait until rates come down? And rather than rebuttal that, which is what I think a lot of us do, I try to ask questions versus going to a script or a rebuttal, because I want them to come up with the answer. So a series of questions might look like, you know, that's an interesting thought. What do you think? Do you think more or less buyers will enter the market when rates come down? And they say more. Okay, more. Do you think that there will still be an inventory problem in 2 years in DFW or wherever? Yes or no? By that point, I've showed them stats about, where the housing market, how builders stopped building basically back in 2008, and the number of family formations have almost doubled. So like we have a compound effect of shortages. If you haven't seen my presentation on that, let me know, but they'll say probably the same. Okay. So if we still have a lack of inventory, but we have more demand, what does that typically do to home prices? Shoots up. So I say, so let's just run the numbers and say, okay, maybe that same $240,000 home is now going to cost you $265. But like you said, the interest rates are down to 4.99. So let's see if that's going to get you a lower monthly payment by waiting. Drum roll, please. If you wait 1 year, your monthly payment is going to be $2,071. But if you buy now at that $240,000 price and we do the rate redo, your payment would be $1,859. Because I can't change what you bought the house for, but I can absolutely change what the rate is. So rather than wait, which is what a lot of our clients did in 2019, and then 2021 hit and they were all pissed off at us because we didn't warn them as if we had a crystal ball. I simply want to tell you that I think if you wait, we're going to be back in a market where there's multiple offers, waiving all contingencies, and that is almost more infuriating than even what people are dealing with now. So my suggestion is that you don't deal with that high demand of buyers. You lock in your sales price now. We drop the rate for you when they're down with our 0 out-of-pocket rate redo, which would actually get you a lower payment than waiting. So that's another strategy of like, if you've got one of those clients that tell you, I think I'm going to wait until the market settles down, please let us talk to them. Let me run this for them. And it's not because I'm trying to get a paycheck out of them. It's because literally the math is the math. All right. Last thing I want to show y'all. This is mainly for sellers. That's my son. He just started kindergarten. My little Iron Man. All right. A lot of you guys know about temporary buy downs, but not necessarily pairing it with a strategy to get your offer accepted easier. So I wanted to share this with you. This is our buy down calculator. I'm happy to email it out to you guys so that you can have it and run it for any buyers or sellers that you have. We, of course, will do this for you as well, but it's kind of dummy proof. All you have to adjust are the 3 yellow cells. But let's say you've got a client that is wanting to make an offer at $475. They have a 5% down payment. And let's say the starting interest rates today, based on Denise's most recent Instagram post, is 7.25. This means that in their first year of owning that home, the rate would be 5.25. The second year, it would be 6.25. Here's what I want to show you. What you would have to offer, or what you would have to request from a seller credit or builder credit or whatever, is $10,636 to take advantage of this 5.25 or 6.25. I went over that really fast. I've got a separate video that explains how 2-1 buy downs work, or 1 year buy downs, or 3 year buy downs. Here's the strategy behind the buy down. If there's a house that's listed at $475, I have real estate agents, clients care about the sales price. I don't want to say they care about it more than the net, but if you get 10 offers on a home, you're filtering them first by sales price, right? So this agent that we work with would take that list price and they would bump it to $485. So now to the seller, you're offering $10,000 over list, assuming it's going to appraise. Here's an offer at $485. It's $10,000 over list price, but embedded, of course, in the contract, you're asking for a $10,600 seller credit to give your client a 5.25 rate and a 6.25 rate. Just saves them monthly, but to the seller, it looks more attractive because the offer is higher. That's one way. Another way that listing agents are doing this is when they've got a listing, they're beating the builders at their own game. And they're like, because by the way, this is what builders do. Those incentives are coming from the price of the home. So do the same thing with your listings. If you've got a listing at $475, bump it up to 485 and say, you could buy this house at a 5.25 interest rate. Ask me how. It's attractive. Throw it all over social media. Now you've got people who are like, how the heck can you buy a house with a 5.25 rate? You see builders doing it, but you don't see real estate agents doing it. So the way that this calculation works, just so you know, is it is based on down payment and loan program. So on this first tab underneath here, this tells you what the max credit is from the seller that you can get. So it's not really anything you need to know, but like if you put 3 to 10% down on a conventional loan, the max the seller can credit is 3%. And then you can do a little bit more based on these other loan programs. But that comes into play when you do a 3-2-1 buy down, which we can do. Builders are doing that right now. But I have seen clients use a 1-year buy down to save contracts from falling apart. So sometimes the lender screws up and you get a call from that buyer's agent that says, hey, the financing's falling through. Before your knee-jerk reaction is to throw your commission check at it, you might be able to do a 1-year buy down, or you might be able to get a seller credit to wipe out the monthly mortgage insurance, let's say, to get the payment in line, to get the debt to income in line. There's all kinds of things that you can do within a loan. It's just, is that loan officer that they're working with even strategic enough to be thinking of things outside of just asking for your commission check to make the numbers work? You know, like sometimes you'll see, well, they had their credit pulled and this monthly payment popped up, so now their debt to income ratio is out of whack. If it's ever a debt to income ratio thing, that's an onion and there's a lot of layers to it. And that person better be strategic in looking at it. And if not, your deal could fall apart just because you're working with someone that isn't a strategic thinker, you know? So even if it's not, shout out to Ronnie. Ronnie was representing a seller, had this happen with his buyer. The buyer got turned down from another lender. He was like, hold on, before this deal falls apart, you got to talk to my lending team. We talk to them, get them in the home, approved, closed, funded. Why? We didn't do anything illegal. We just looked at the onion differently and put the layers together differently. We help about 60 families a month, so that repetition of scenarios matters when you're working with a lender. If they close 1 or 2 deals a month, they're not seeing enough scenarios to have that strategic part in their brain exercised enough, you know? So this 2-1 buy down calculator, I can send this to you guys. It's great for listings and all that stuff. The example for using FHA versus conventional, let me find that. I'm going to look at the chat. So if you guys got questions, throw it in. The example of FHA versus conventional is helpful when looking at the market aspect. Yes. As well as VA. A lot of veteran clients think that, you know, once you've gone veteran, you should always go veteran. And it just depends on how much money they're putting down. If they're a repeat veteran buyer, sometimes the math is better conventional. But the most important thing that we're doing with your clients is we asked ourselves, you know, the last time you went to a restaurant or to a hotel, when you walked away, when was the last time you had like a wow client experience from that? Like if you think back in the last 12 months, like when have you had a really good experience where you're like, wow, and you told somebody about it? And you write that down, get everybody on your team to write it down, and then ask yourself, what about that experience made it so memorable? And our team came up with 3 things. I don't know if I should tell you guys because I want you guys to come up with it, but we came up with 3 things and then we've applied it to the real estate world. But it was usually that something happened that was unexpected. It was over the top, and it was meeting a need that we didn't even know that we had. And when you had those 3 things, you felt like you had a really good client experience that you would want to tell other people. And that's our commitment to each and one of you. Anytime you send a buyer to us, we want to deliver on those 3 things to help you generate more business back to yourself and to the team. That's it, plain and simple. So Thank you guys for hopping on. As I mentioned in the email, this Sunday we have our big annual client event. I would love to see each and one of you guys there. It's right here in Little Elm. We rent out the entire water park for clients to one last summer bash. So you guys are more than welcome to pop in. It's from 10 to 12. The park stays open afterwards, but it's private just from that 10 to 12. So come after church. And then Tuesday on the 22nd, the owner of Keeping Current Matters, who a lot of us subscribe to, who comes up with all those statistics, is doing a a small mastermind open Q&A roundtable of like, where's inventory going, where's interest rates going, where are home prices going, and how do you answer those questions best with your clients. He's doing that just for the benchmark loan officers here locally. So if you got my email, if you didn't get my email and you're on this Zoom because of social media, just shoot me an email. You've got my email. And just remember, guys, on my, I promise this is the last thing I'll say, is on my social media, this link here, shucks, let me go back here, Instagram. This is really good for you guys to just have, is if you want a quick, easy link to give to your clients, if they come to my Instagram and click on my link tree, the link tree has really good resources of videos and stuff of like buy a home and then sell our non-contingent program, get started with home buying, let's chat about credit and FICO scores, most common home buying questions. These are all videos of like, what kind of documents am I going to need? What are the 4 types of loan programs? You know, don't take my word for it. Here's what clients are saying about us. If you haven't looked at our Google reviews, it's pretty powerful when you're showing clients this, because we have the most Google reviews in Plano, Texas, 347. And so it's like, hey, client, don't take my word for it. Go read their reviews. All of them are like recent. So all of them say great service, great rates. They showed me behind the curtain, highly recommend, yada, yada. So anyways, thank you guys for tuning in. Any other questions for me? Are you finding appraisal issues with FHA? No. Why do realtors think that there are differences with FHA appraisals? There are with VA, but with FHA, it's the same appraisal process. I don't know if people know that. It's kind of a change. Oh my God, I just saw Carrie Himmel's pretty face. Hi. Oh, all right. Well, that's all. Thank you guys for tuning in. I will send the recording out. If you had any team members that missed it, please, please, please share this with them. But y'all, your clients need advice more than ever. So we are committed to giving that to them. If you guys have any questions for me, holler at your nerd. Y'all take care.